Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. As you can see, the portfolio is doing all right. Over 57,000 right now, and a lot of that obviously, so I put some money in this week, but as you can see is right now in profit of about over £5,000 and almost 10% up, and that's really good. That's like where we were in comparison to where we were at the beginning of the month. Okay, is up almost £5,000, and I think I'll probably put in about 1,000 give or take, right? I will be doing a portfolio update very soon, so we'll talk about that later. But today's video, we are going to talk about a company that I have not spoken about for a very long time. One of the companies that I own in my portfolio. So we want to see if this company is a good addition to your portfolios. Again, I'm not a financial advisor. I'm giving you the facts, so you then have to go away and just do your own research. Okay, but before I do that, if you're enjoying this content, if you're enjoying this free content, you don't have to pay me, you don't have to buy a course, nothing like that. Like I've always said to you guys, I'm only sharing my journey and what I've learned so far in the stock market. All I need from you is just subscribe to the channel, like the videos, share with your family and friends, and let me know if you have any questions. I'm more than happy to answer. Okay, now the company that we're going to talk about today is Union Pacific. I own this company in my portfolio. I have 12 shares, £2,249 worth of shares, and I'm up right now about 22% or over £400. It went down recently. I was up almost to £500, but I haven't spoken about this company for a long time, so we want to see if that is a good buy right now or what I'm going to do in the going forward. But before we do that, we talked about the stock market, how important this week was to the stock market. Okay, and yeah, it was. So when we look at this week, it hasn't been that bad. The only couple of stocks that actually went down quite a bit is Meta. Again, Meta, for the first time probably in over 10 years or whatever, they missed their revenue, their earnings and things like that. So that's why they're down quite a bit. But almost every other company, look at Microsoft. I was quite surprised. Okay, the fact that it was down at one point on the day they reported, I think we talked about that. Okay, but right now look at it, basically 4% up just for the week. Apple is up again as well. Google was up at some point. Amazon went down and then came back up. Okay, and then you've got a couple of other consumer discretionary companies that are down. So for the week, it hasn't been as bad as we expected. And when you look at the oil sector, I think the oil sectors are up a lot today because these two companies have reported absolutely amazing earnings. So Chevron and Exxon, both of them actually reported amazing earnings report. So yeah, it hasn't been a bad week at all as we expected. Obviously, the Fed came out and said 0.75 is what they actually increasing by the interest rates. And that was what was expected. So the markets were happy with that. So generally, these companies came out more or less, hit their targets or beat their targets. Okay, their forecast is actually not as great as it should be. For companies like Qualcomm, it's actually down quite a bit because they beat both top and bottom, I think. But the issue was they lowered their guidelines. So they've said they are predicting less in next month, and for that reason, it's actually down quite a bit. Overall, it's been really good. Okay, so the company that we're going to talk about today, like I said, is Union Pacific. This is a railroad company. This is basically a company that operates on more than 30,000 miles of track in the western 2/3 of the US. They've generated over $22 billion in revenue in 2021. So they're not really a small company at all. So we are now going to look at the financials. Okay, and then at the end, I'm going to show you the whether this company is Sharia compliant or not. So like I said, it's a railroad company, it's an industrial company, currently trading $227 per share. It has an EPS right now as a $10.74, and the next year they're expecting about 12.64. And as you can see here, the market cap is $142 billion. It has a wide economic moat and it has a beta. So when we talk about this, one of the brothers actually asked me a question about what does it mean when we say wide economic moat. This means basically this company has a competitive advantage. Okay, that's all that means. So a wide moat is quite good. Narrow is quite basically narrow because and then you've got none. Some companies have absolutely no moat whatsoever. So Warren Buffett always talks about, you know, companies that have a competitive advantage, like Coca-Cola, for example, right? So that product is actually quite unique. They have a competitive advantage, even though there's a lot of competitions out there. Okay, they stand out of the crowd. Basically, that's what it means. And the beta, what we're looking for is something that's lower than 1. The reason for that is because if the beta is above 1, then that means the stock is very volatile. So when stocks go up, it will go up a lot. When it goes down, it will go more than the stocks go down, basically. Okay, so when they go up, it might not go as high as basically the rest of the market. PE is 21, so it's kind of all right when in comparison to the sector. So the sector we're looking about right now, 21.44, and PE for Union Pacific is 21.20. Price to free cash flow, more or less the same, 23. Dividends, they have a nice dividend, 2.32% of dividends. In terms of the 5-year growth rate, we're looking about 14%. Dividend growth streak about 23. So they soon will become 2 more years and they will become a dividend aristocrat. And I'm sure that's something they will be proud of. I'm sure there's something they want to do. Payout ratio, we're looking about 44. Now, the payout ratio is very important because that's basically the companies make money and then they have a net income. So the net income is basically what they use. So what's left after they paid their taxes and overheads and all that stuff, the net money, the bit that's left. Okay, so the cash they have, that basically they're using 44% of that net income to pay as a dividends. Okay, so they have a room to improve. If they wanted to, they can give us higher, but some companies use a lot more. Okay, so they will have like a payout ratio about 70. So that means that company is very dangerous. If they're using 70 or 80% of their net income, when the net income reduces and the earnings is not as good as they're supposed to be, then they can easily cut that dividend. So it's all, this basically tells us a lot about the company. Okay, so dividend safety. This is why I actually love basic dividend stocks, because once you have this, then they can't hide that. You can easily calculate the payout ratio. So you can't basically, companies that do not pay dividends can easily hide these things. But when it comes to dividends, you have to pay. So once you've actually paying that dividend, we want to know where is that coming from. All right. So it's a net income. If the company has a positive net income, then obviously they will pay you. If they don't have a positive net income, then they're not going to pay you. Right. So dividend safety, according to Simply Safe Dividends, is 88%, which is one of the highest. So the highest is 99%. Free cash flow, $5.6 billion right now in the bank that they can use for all sorts of things. Okay, 5-year growth rate, we're looking about the revenue of 1.8. That's quite low, but the projection in the next few years is actually higher than what it was. So around 2012, 13, 14, 15, I think they had a lower revenue growth. Okay, but lately they have actually grown a lot. So that's why on average is 1.8%. Okay, 5-year EPS growth, we were looking about 14%, which is really nice. Profit margin almost 30%. Operating margins 41%, almost 42. Return on equity, we're looking about 52. Total return, okay, we're looking about 15% in the last 10 years. So if you own this stock in the last 10 years, you would have averaged every single year 15%. Current ratio is below 1. Normally we're looking for above 1. So that means the company basically should be able to cover, if it's above 1, should be able to cover their debt basically levels, the current debt, in the next 12 months. But the fact that they have a $5.5 billion in cash, I wouldn't worry too much about that. And again, that's that if it's lower than 0.5, then I would be worried, but I think that should be okay. Okay, and then you got next 5 years, we're looking about 14.5%, almost 15% growth in the next every single year of the next 5 years. That's what they're expecting. So that is the bit, one of the reasons I'm in this stock, the fact that their growth, this is a very old company, but they grow in their basically earnings about 15% every single year in the next 5 years. That's the basically expected. Anything can happen, by the way. This is just what the analysts basically are saying. This could change definitely. Simply Wall Street is saying 14, almost 15% undervalued at the moment. Their price target is $287 per share. Morningstar is saying it's fair value, $211 per share. TripRank is saying big 10% upside, 238. Yahoo analyst is saying 240. So everyone is more or less kind of above 200. And right now, it's, if you look at the stock, $227 per share. So it is undervalued according to simply Wall Street, according to TipRank, as well as Yahoo Finance. Morningstar is the one I always go with because they have I like the fact that they have a lot more margin of safety, and that's what I normally go for. So $210 or 200 was my target to add to this stock if it goes, because I need to buy 3 more stock, basically shares of this company, to round it up to 15 shares of this company. And moderate buy, I would definitely agree. Right now, I wouldn't rush buying it straight away. If it goes to 200 or below 200, perfect, then you can start adding. Maybe if you have it already, I'm definitely would be adding to it. So like I said, I've got 12 shares and I will love to add to it if it goes below whatever. Like right now, you can see 200 was my target. So price alert, I'll put it 200. And when you look at my average price, is $212 per share. So it's just above that. So if we go to 200, perfect, then I should be buying. And I think it hit at some point, but there was so many other companies. I think it got up to $205 per share in the last 3 months. But if it goes below that, then I might actually be looking again to buy a little bit more of this company. So that is Union Pacific. So let's go back quickly before I forget, because I did forget last time when we were talking about ADVI in terms of Shariah-compliant side of things. So UNP is the stock that we were talking about today. From business activity side of things, okay, it's almost 100% fine. There's no issues. It's compliant. In terms of interest-bearing debt, 25. So 25 is my kind of cut off. Anything above that, you are in a dangerous territory, because remember, we're looking about 30 to 33 depending on what you're looking at. Okay, so if you're looking about 30%, it can easily go up 5%, and I've seen that before, where when I had to basically sell what is it called, Stanley Black & Decker. Okay, and then interest-bearing securities, that is 0.6. That's absolutely nothing. So again, that is Union Pacific. That's the company that I want to share with you guys today. I hope you enjoyed the video. I would absolutely love if you have been here this long, if you can actually give the video a like. Let me know if you have any questions. Let me know what stocks that you own. If you own this stock, if you own any of the companies that are industrials, okay, what's your favorite industrial company? Let me know about that as well. Have a wonderful day. Assalamu Alaikum.